Good afternoon, and welcome to Bulls, Bears, and the Bell. Thank you for joining us. We are diving into a really fascinating market moment this week. It all centers on a pretty dramatic shift we saw play out on Monday, October 20th. What we witnessed, I think, wasn't just a bounce. It felt more like a full-scale, decisive risk-on pivot. It just seemed to radically alter the whole near-term picture for U.S. stocks.
It really did. It was this sudden, almost aggressive shedding of fear. And the interesting part is it didn't come from one single overwhelming piece of good news, right? It felt more like a simultaneous lifting of these two massive psychological burdens that had, frankly, been paralyzing how investors were behaving.
Okay, so that's our mission today then, to unpack these powerful dual catalysts, understand how they kind of interlock to trigger this shift.
Exactly. And then crucially, we need to look at the immediate tests this newfound optimism faces, for the rest of the week, because things can pivot back just as quickly if the underlying data doesn't stack up.
Right. Okay, let's unpack this. The big picture hook here is just the speed, the sheer speed of the climb. Yeah, the major indices, S&P 500, the Dow, NASDAQ, they all just surged. And it brought them right back. I mean, literally points away from their all-time highs. That's not really about growth yet, is it? It feels more about the immediate absence of those collapse scenarios.
Precisely. That's a great way to put it. For weeks, the market was operating under this cloud of really acute uncertainty. Everyone was fixated on two potential, catastrophic outcomes. The first was that terrifying possibility of systemic credit contagion, a sort of slow-motion banking crisis sparked by stress in the regional lenders.
Which we were hearing a lot about.
We were. And the second was the threat of an accelerating U.S.-China trade war. I mean, that just threatens global supply chains, shuts down growth prospects almost instantly. So when those two distinct fears eased kind of at the same time, the psychological dam just broke. And the path was immediately cleared for bullish sentiment, which then was kind of fueled by this building optimism around Q3 corporate earnings season.
So dual relief. Containment of the regional banking fears and this apparent immediate thaw in U.S.-China trade tensions, that was the 1-2 punch.
That allowed the bulls to finally charge, yes. But before we get too deep into the why, we really have to quantify just how monumental this move actually was. Yeah, the indices did more than just log gains. They executed what looked like a textbook technical reversal. Let's start with the benchmark, the S&P 500. It advanced pretty robustly. We saw gains ranging between, say, 0.53% and an impressive 1.19%, depending on the exact sector weighting you're looking at. And this advance was fundamentally significant because it successfully defended a major indicator, that key 50-day simple moving average.
Okay, for listeners who maybe aren't staring at charts all day like us, can you quickly remind us why defending the 50-day SMA is such a big deal right now? It sounds technical, but it feels like a huge psychological benchmark.
It really is. The 50-day SMA, it's basically a barometer for the intermediate term trend. When the market falls below it, it signals that the recent momentum might be broken. It suggests a deeper, more sustained pullback could be likely. So by holding the line, by defending that 50-day SMA, the S&P 500 essentially affirmed that the recent dip was perhaps just a temporary correction.
Not the start of something worse.
Exactly. Not the start of a new bearish intermediate trend.
And that successful defense allowed the S&P to close, between 6,664 and 6,743, which, as you said, puts it within striking distance of the all-time high, 6,764.66. I mean, it went from defending a tactical support level to challenging a maximum resistance level in basically one session. That's an enormous release of pent-up energy.
Absolutely enormous. Then you look at the Dow Jones Industrial Average. It added over 0.5%, 0.52%, which was more than 238 points, closed above 46,190. And crucially, the Dow has now put together a 1.4% gain over just 2 trading sessions. That signals some powerful upward momentum as it targets its major resistance threshold, right around 46,800.
Momentum traders must be watching that level very close.
Oh, definitely. But if you really want to know where the speculative appetite is flowing, you look at the NASDAQ composite. The NASDAQ dramatically outperformed the broader indices. That's a classic risk-on tell, right?
Right. Tech leads the charge.
The NASDAQ was the true star here, gaining up to 1.5% in some metrics, closing above 22,670. And that performance was really anchored by the mega-cap tech components. We saw significant strength in, say, Apple, for example, but also this renewed bullish stance on the entire semiconductor complex.
Ah, the semis.
Yeah, and this was partly influenced by some positive commentary from ASML, the Dutch chip equipment supplier, from the previous week. ASML's positive outlook basically suggested that global chip manufacturers are continuing their heavy capital spending, which implies confidence in future demand.
Especially for the high-end chips, AI, cloud stuff.
Exactly, the stuff driving AI and cloud infrastructure. So when tech leads the charge like this, the whole market reads it as a confident move into those longer duration assets.
Okay, indices up strongly. But maybe the most profound quantitative signal of fear receding wasn't even in the index prices. It was in the collapse of the anxiety index. The VIX.
Yeah, the sheer magnitude of the VIX retreat is, well, it's fascinating. It had spiked, remember, near 28.99 the previous week. That indicated significant panic when those credit contagion fears were really peaking. Then on Monday, the VIX just plummeted, down between 12% and nearly 18%, 17.9%, closing decisively below that critical 21 threshold. This drop isn't just a statistic, it's a behavioral event.
Can you elaborate on that, the behavioral element? Because, 17.9% drop in one day suggests a flood, not just a gradual shift?
Right. When the VIX drops that hard that fast, it usually means two things are happening at the same time. First, the volatility sellers, the institutions that profit from shorting volatility, they're aggressively piling back in. They're betting the worst is truly over. Second, and maybe more importantly, it signifies this complete liquidation of short-term hedges. Traders who bought protective put options last week, hedging against maybe a 10% market crash,
They're dumping them.
they're selling those options back aggressively now, often at a loss, because the perceived risk has just vanished. And this mass selling of insurance, quote unquote, acts like this powerful quantitative signal that investor anxiety has been rapidly, forcefully diminished. It's like the market literally exhaled. And you can measure the force of that exhale in the VIX's move.
But if the VIX shows fear disappearing, where did all that fear come from? We need to look at who was actually positioned for a crash, right? Because that positioning is what made this rally so, well, violent.
Absolutely. The rapid upward move was definitely amplified by how defensively investors were positioned coming into the week. We often look at the AII Investor Sentiment Survey. As of October 15th, it showed this really pronounced bearish tilt. A staggering 46.1% of retail respondents identified as bearish. Only 33.7% were bullish. That's classic crowding on one side of the boat.
Okay, so if nearly half the investors were expecting a decline, what happens when the market moves sharply up instead?
Well, that's the mechanism of the pain trade, because such a huge chunk of the market was defensively positioned, maybe sitting in cash, maybe fully hedged with options, or even outright short the market when the positive news hit. They were forced to scramble. They had to cover their short positions, which means buying stock. They had to liquidate their hedges, which often also requires buying. And this forced buying, this sort of stampede back into the market just to avoid being left behind.
Inflicts maximum pain.
Maximum financial and emotional pain on those who are positioned for a decline. Yes, it acts as this enormous self-feeding mechanism that turbocharged Monday's rally far beyond what maybe the news itself would normally warrant.
Okay, that sets the stage beautifully. Let's dig into the specific core catalysts then, the things that allowed the market to transition from that defensive kind of coiled spring position into the pain trade. Let's start with the domestic financial fear, the containment of credit contagion.
Right. The primary concern coming into Monday was definitely systemic credit stress, in the regional banking sector. It was fueled by those recent announcements of loan charge-offs, exposure to commercial real estate.
Felt very real for a bit there.
It did. But on Monday, that fear seemed to just evaporate. The market treated the situation as contained, not systemic.
What was the hard evidence, though? What reassured investors that the illness wasn't spreading?
Well, the evidence was right there in the price action of the large systemically important lenders, the big national players. Wells Fargo, Citi, they both advanced strongly, nearly 3% each. This suggests investors were actively distinguishing between, potential regional vulnerabilities and the overall health of the national financial architecture. Money rotated back into these major lenders,
Like they were the firewalls.
effectively betting that the contagion wouldn't jump from the smaller banks to the giants. Yes, they were seen as the firewalls.
And the market even showed some preemptive optimism for the smaller, maybe more stressed regional players. Making Zion's Bank Corporation, Zion, the sort of ultimate test case for this whole narrative.
Zion's was absolutely critical. They'd been right at the epicenter of the stress because of that $50 million loan charge-off they disclosed the previous week. That had really scared the entire regional banking index. Yet, ahead of its after-hours earnings report on Monday, the stock actually rose 1.8%. That preemptive rise was a loud signal from traders
What was the signal?
that the prior week's sell-off was probably overdone. And they were betting that Zion's upcoming report wouldn't show some catastrophic systemic deterioration in loan quality that could trigger broader panic.
Now, hold on, though. Is the market maybe being a bit too simplistic here? I mean, is one regional bank reporting slightly better than feared really enough to declare the credit crisis over for the whole system?
That's a profoundly important question, and the answer is, well, yes, the market is often simplistic in the short term. The pivot wasn't based on definitive proof that all regional banks were suddenly safe. It was based more on the absence of immediately terrifying news that would validate that recent spike in fear. Zion's served as a psychological proxy.
Ah, okay.
The thinking was, if Zion's, the most stressed name in the headlines, could avoid disaster, then maybe the broader, less stressed names must be okay. It was an extrapolation driven purely by relief. The actual long-term reality, of commercial real estate exposure, that's going to unfold over quarters, maybe years. But the short-term sentiment risk was effectively dealt with by Zion's perceived stability.
Okay, that makes sense. Let's move to the second major overhang that lifted, the U.S.-China trade tension thaw, the geopolitical catalyst.
Yeah, this one was driven almost entirely by political rhetoric and diplomatic activity. The market had been fearing a swift escalation after weeks of vague threats. The significant tailwind came from a perceived de-escalation regarding potential new, severe tariffs on Chinese goods. And the key quote that really served as a powerful market-moving signal was President Trump's public comment. He said that a plan for 100% tariffs was, quote, not sustainable.
That single word, unsustainable, that's critical, isn't it? Because it shifts the whole risk profile from definite punitive action is coming to, okay, there's room to negotiate.
Exactly. It quelled those worst-case fears of a full-blown trade war. And it immediately boosted trade-sensitive sectors, especially, tech and materials that rely heavily on global supply chains running through Asia. And this narrative was strongly supported by reports that Treasury Secretary Bessent and Chinese Vice Premier He Lifeng had a meeting described as constructive.
Just the fact they were meeting and calling it constructive.
Right. The very fact that high-level economic communication was active and described positively signaled that maybe both sides prefer engagement over immediate conflict right now. The market read that as the official green light to re-engage with those global growth stocks that had been beaten down by all the trade uncertainty.
Okay, so with the specter of credit stress and the trade war receding, the market finally had the confidence to focus on what it truly needed, fundamental justification, which comes via Q3 earnings season.
Yeah, the market desperately needed this fundamental support. As we noted earlier, stock prices have surged, 35% from the April lows? That kind of valuation really requires profit growth to back it up. And we saw crucial early wins supporting the bullish bias. Better than expected reports from major banks like Bank of America, Morgan Stanley. They showed strong trading revenues, managed loan losses that helped restore confidence in financial health. Even a strong report from an industrial firm like Cleveland-Cliffs suggested that underlying industrial demand might still be resilient. These early corporate reports suggested that the micro-level health of American business was robust enough to at least attempt to justify the market's elevated valuations.
And this risk-on pivot wasn't just a stock market thing, right? We saw capital rotation confirmed across the whole asset landscape, starting with a powerful retreat from safety assets. Let's talk about gold.
Yeah, gold is the classic countercyclical indicator, isn't it? It had recently set a record high, pushing above $4,300 an ounce. That was entirely fueled by safe haven demand from the banking turmoil, the trade war uncertainty.
Money running for the hills buys gold.
Exactly. When fear peaks, gold shines. But on Monday, that momentum just stopped dead. Gold futures retreated sharply back towards the $4,200 level.
And when gold backs off from record highs like that, it's not just a price drop, it's a signal, isn't it? That the acute fear is gone and capital is actively moving out of non-yielding assets and into assets that can potentially capture economic growth.
Precisely. It confirms that rotation into riskier, growth-oriented investments. And then on the other end of the spectrum, you have something like Bitcoin, which often serves as this highly sensitive proxy for speculative appetite for liquidity in the system.
And Bitcoin definitely confirmed the risk-on mood, didn't it? It was like a high-beta thermometer for global sentiment.
Oh, it rallied over 4%, stabilized convincingly above that psychological $111,000 level. That's after touching multi-month lows during the worst of the prior week's turmoil. This kind of rebound in speculative assets, it signals a renewed willingness among market participants to embrace volatility, maybe high leverage positions. It indicates that the fear of a broad systemic liquidity crunch, which typically crushes speculative assets, has been replaced by a hunt for yield and, high potential returns.
But the true fulcrum of sentiment, the asset that really dictates the mood for the entire financial sector, that's the 10-year Treasury yield, the TNX.
Yeah.
And it's stabilized critically around that 4.00% threshold.
Yeah, the 10-year yield is acting as maybe the single most important psychological and operational benchmark for the current market. It traded in a tight stabilizing range right around 3.99% to 4.01%. Now, why is stability here so important? Well, last week when the yield dipped below 4%, it was widely interpreted as a warning signal, like a collective bond market bet on underlying longer-term economic growth concerns, maybe even signaling an imminent recession.
So its recovery and stabilization above 4.00% is actually a bullish sign for stocks
Yeah.
because it refutes that immediate recessionary threat narrative.
It absolutely refutes that negative growth story, at least for now. But there's also a critical functional reason this is bullish, especially for the financial stocks we just talked about. A stable or rising long-term yield is essential for banking sector profitability because of net interest margin, or M.
Right, the spread.
Exactly. Banks make money by borrowing short-term, that's what the Fed influences, and lending long-term, which is reflected in yields like the 10-year. When the 10-year yield is stable and sufficiently higher than short-term rates, the bank's NMM, their profit margin on lending, is healthier. So this stabilization around 4% is directly supporting the entire financial sector and is crucial to the market's belief that the credit fear is contained.
Okay, now here's where the narrative kind of hits a wall, isn't it? Because not every global asset was participating in this bullish party. We saw a stark, almost cautionary divergence in the physical commodity market, specifically with WTI crude oil.
This divergence is, I think, the most crucial flashing yellow light of this entire deep dive. WTI crude oil declined sharply. Trading around $57 a barrel, that's diverging emphatically from rising equities. So why is oil dropping when global growth fears are supposedly easing? Well, the weakness seems directly attributable to some sluggish economic data released by China over the weekend.
China being the world's largest energy consumer, right? So their economic health is just inextricably linked to the price of oil.
Exactly right. The hard data from China showed Q3 GDP growth easing to 4.8%, retail sales growth weakening, fixed asset investment declining. This is a pretty clear signal of slowing global demand. The physical market oil is pricing in the reality of a slowing Chinese and potentially global economy.
So let me get this straight. The U.S. equity market is soaring because of positive China trade news, rhetorical easing of tariffs, while crude oil is dropping because of negative China economic news, actual weakening demand. It's almost like a classic case of denial by the stock market.
It is classic selective hearing. The U.S. equity market chose to ignore the bad China economic news that's the chronic, maybe long-term risk of slowing global growth, to focus exclusively on the good China trade news, the acute, immediate relief from a trade war. The physical commodity market is always closer to the global reality of supply and demand, and it is pricing in weakness. This divergence is a significant underlying risk that the equity market is, well, for the moment, happy to ignore. It prefers to believe in domestic resilience.
It's like we're celebrating that the light turned green, but the commodity market is quietly pointing out that the bridge ahead is actually closed.
That's a good analogy, yeah.
Okay, the sector deep dive seems to confirm this as a textbook risk on rotation then. It perfectly aligns with our two main catalysts, right? Money poured out of safety and flooded into areas tied directly to financial stability and global trade.
Absolutely. The leaders were exactly who you'd expect when credit fears ease and trade tensions thaw. You had financials, XLF, technology, INFT, and industrials, INDU, all posting gains well over 1%. Financials were buoyed by the yield stabilization and the containment of credit fears we talked about. Tech and industrials, which are probably the most leveraged to the global supply chain, they were the primary beneficiaries of the relaxed rhetoric on U.S.-China tariffs.
And conversely, the laggards confirmed the rotation out of safety. Defensive sectors like consumer staples, utilities, they were flat or even slightly down. That tells you investors weren't looking for safety. They were aggressively seeking growth potential.
And we also saw some really dramatic, specific movement in individual stocks that kind of illustrate distinct investment themes. Let's start with a high-stakes binary event, biotech euphoria.
Right, so Celcuity, ticker CELC, surged nearly 40% to close above $72. That kind of volatility is typical in biotech, but what was the specific driver here?
The catalyst was the announcement of successful phase 3 clinical trial results for their breast cancer drug, iditolcib. They presented it at the prestigious ESMO Congress. Now, for a clinical stage biotech company, a successful phase 3 trial is the ultimate de-risking event. It provides the proof of efficacy needed to move towards regulatory approval. So a stock like CALC can instantly, dramatically revalue because the probability of blockbuster revenue just shifted from, theoretical possibility to something much more tangible. It perfectly illustrates that high-risk, high-reward nature of betting on breakthrough innovation in the sector.
Okay, next let's look at Cleveland-Cliffs, COF. Jumped a massive 17%. Now, they reported a net loss, although it was narrower than expected. But the real driver here sounds like a massive strategic pivot. This is a fascinating story, especially for anyone looking at how companies respond to geopolitical pressure.
This is perhaps the most significant long-term insight from Monday's corporate news. The CEO, Lourenco Goncalves, announced a strategic plan to explore rare earth mineral production at their mining assets in Michigan and Minnesota. This instantly transforms the company's investment narrative. CLF was traditionally viewed as just a cyclical commodity play, right? Tied directly to the up and down health of the steel market. That usually gives it a lower cyclical valuation multiple based on something like EBITDA.
But moving into rare earth minerals fundamentally changes that calculation.
It changes everything. Rare earth minerals are critical inputs for, well, everything from EV batteries to advanced defense technologies. This move is a direct strategic response to China's dominance in the sector and the U.S. government's powerful push to secure domestic supply chains. CLF is now potentially transitioning from just a cyclical producer into maybe a strategic national asset, a participant in that long-term trend of resource localization. This pivot attracts a completely new class of investment interest, potentially justifying a much higher strategic valuation multiple, far above what a typical steel company might command.
Really interesting. Conversely, let's look at the cautionary tale. OBOOK Holdings, ticker OWLS. Their shares plummeted nearly 27%, closing below $29. This feels like a lesson in market gravity.
Oh, this is essential viewing for any new investor, I think. OBOOK had that massive debut last week following its direct listing, surged, 580% above its reference price, driven by euphoric momentum around the blockchain technology narrative. But that initial massive pop seemed completely disconnected from measurable fundamentals or sustainable earnings. Monday's 27% drop, which continued a steep decline from Friday, reflects aggressive profit-taking and the rapid dissipation of that speculative liquidity. It just shows how quickly the gravity of valuation fundamentals reasserts itself once the initial IPO or direct listing euphoria evaporates.
A reality check. Okay, finally, let's circle back to the regional bank test. The whole bullish rally on Monday was built, as you said, on the assumption that credit fear was over. That brought all eyes to Zion's Bank Corporation, Zion, reporting after the bell on Monday.
Yeah, this Zion's report was the critical litmus test for that entire credit fear is over narrative. Remember, Zion's was the focus of the panic last week, so investors were intensely scrutinizing management's commentary on three core areas, going well beyond just the headline EPS number. First, overall loan quality. Are non-performing loans spiking? Second, provisions for credit losses. How much money is Zion setting aside for future potential loan losses? A conservative management team would significantly raise provisions, which drags on earnings but reduces future risk. And third, net interest margins. NIMs. Are they successfully managing their funding costs in the current rate environment?
And what were the expectations going in? Consensus EPS was what, $1.40 to $1.46, sir?
Exactly, and this is where the market got the validation it was desperately looking for. Zion's delivered EPS of $1.43 squarely within consensus. And the management commentary emphasized strong loan originations and crucially manageable credit quality concerns. Most importantly, they didn't announce any major new surprising charge-offs. This result basically validated Monday's rally. It confirmed, in the market's mind, that the issues were perhaps isolated and manageable, not systemic. If Zion's had failed to deliver this reassuring report, the entire risk-on rally probably would have instantly reversed in overnight futures trading. Monday's gains could easily have become Tuesday's volatility.
Okay, so moving past the Zion's test, the market now transitions, doesn't it? From a sentiment-driven day into a week just saturated with hard data, we're facing a pretty high-stakes showdown between, let's say, bottom-up corporate health and top-down inflation pressure. We start with the dense earnings calendar. That's the immediate microtest.
Yeah, the microcalendar is absolutely packed with bellwethers. These reports will either justify or maybe undermine current valuations, and also the massive role the Magnificent Seven play in market indexing these days. Tuesday after the close, we get Netflix NFLX. This report really tests two core market narratives, that high valuation growth story and the real-time health of the consumer.
What are analysts really focusing on for Netflix specifically? Is it just subscribers?
Not just subs anymore. Analysts are primarily focused on the growth of the new ad-supported tier. The market seems to be pricing in optimism that this ad revenue will provide a sustainable new avenue for high-margin growth, offsetting maybe slowing subscriber acquisition rates in mature markets. If that ad tier growth disappoints, it challenges the whole thesis that streaming giants can maintain their sky-high multiples just by diversifying revenue streams.
Got it. Then on Wednesday, another Magnificent Seven reports. Tesla, TSLA. Given the recent softness we've seen in EV demand globally, this one seems particularly high stakes.
Tesla is such a crucial barometer for the entire electric vehicle demand story. Investors are looking past just the sheer volume of deliveries now to focus intensely on margin pressures. Is the ongoing price war, where Tesla keeps cutting prices to try and spur demand, is that continuing to eat into profitability? A strong report here could signal that margin pressure is easing, which would validate the bullish stance on EV dominance. A weak report, however, could ripple through the entire tech and growth space. It might suggest that those high multiple, high growth assumptions are maybe flawed when they face economic reality.
And closing out our trio of tech giants on Thursday after the close, we get Intel, INTC.
Intel provides a vital, necessary check on the semiconductor cycle and, maybe more broadly, the core demand for AI-related hardware. Intel's commentary on things like capital expenditure and future foundry utilization will shed light on the direction of the underlying infrastructure build-out. Since AI demand has been such a key engine of the market's entire year-to-date performance, any sign of slowing expenditure or delayed rollouts from a major player like Intel could potentially temper expectations for the whole high-growth tech trade.
Okay, so these mega-cap earnings provide the bottom-up check. But the biggest top-down event looms large on Friday morning. The critical macro event, the CPI inflation report.
This is absolutely the main event. It's the data point that will likely dictate Federal Reserve policy expectations and could overshadow all the micro reports from earlier in the week. Friday, October 24th, 8:30 a.m. Eastern, we get the Delayed Consumer Price Index, or CPI report for September. This is the single most important piece of data for influencing interest rate decisions right now.
And what are the forecasts? What are the stakes here?
Well, Wells Fargo, for example, is forecasting a plus 0.4% month-over-month increase in headline CPI. If that holds, it would lift the year-over-year inflation rate to a 16-month high of 3.1%. The stakes are incredibly high because the market is currently pricing in a very dovish monetary outlook. It's anticipating 2 more 25 basis point rate cuts before the end of 2025. This anticipation of looser money is really one of the pillars supporting the current rally.
So a reading of 3.1% year-over-year inflation, or honestly anything hotter than expected, would fundamentally challenge those dovish expectations, wouldn't it?
Precisely. A hot CPI reading directly challenges that aggressive expectation for loose monetary policy. If inflation is actually reaccelerating, the Fed cannot credibly deliver those cuts. It would instantly cap the rally, I think, because the market would be forced to refocus on renewed interest rate risks, regardless of how great corporate earnings might have been earlier in the week. The market hates fighting the Fed, right? And this CPI report could put the market and the Fed back at odds.
We also need to mention the logistical wild card here, which is the ongoing U.S. government shutdown. That's causing some data dependency headaches, isn't it?
Yeah, the shutdown poses a tangible operational risk. While the September CPI data collection was likely completed and probably should be released, economists are widely noting that the crucial October report is at significant risk of being skipped entirely if the shutdown persists into the next reporting window. Creating an economic data vacuum like that would introduce enormous uncertainty. For the market, sure, but critically also for the Federal Reserve, which explicitly states its policy decisions are data dependent. Uncertainty about the data is almost as bad data itself sometimes.
Okay, so let's synthesize the thematic conflict for the week then. We have this high-stakes showdown brewing between the micro and the macro.
It really is the classic battle for market direction. Can strong corporate earnings, the positive micro story, overcome a potential hot CPI reading the negative macro story? The rally on Monday was built entirely on sentiment and, as we discussed, the absence of bad news in the banking sector. The rest of this week will be determined by whether the hard, incoming data from corporate America and the BLS actually validates that optimism. A hot CPI would challenge expectations for policy easing. It could potentially cap the rally despite good corporate performance, forcing the market to focus back on interest rate risk over growth potential. Hashtag tag outro refect.
So let's just quickly recap the core findings of our deep dive today. Monday wasn't merely an update. It was a really powerful, sentiment-driven unwind of fear. The simultaneous easing of those acute threats, credit contagion fears, U.S.-China trade tensions, it pivoted the market decisively back toward growth and earnings potential, and it triggered a forceful, position-driven pain trade.
Right. However, the immediate future really rests on the hard numbers now and the ultimate resolution of three major risks that could easily reverse this rapid move. First, the continued stability of credit quality following that Zion's test is really contained. Second, a hawkish CPI surprise on Friday that derails the Fed's expected rate cuts. And third, any significant earnings disappointment from those mega-cap growth stocks, which, let's face it, carry the weight of the entire index on their shoulders.
Okay, here is the final provocative thought for you, our listeners, to consider as you monitor the markets this week. The market chose to celebrate the positive political rhetoric regarding trade, while, it seems, aggressively ignoring the negative, measurable economic data coming out of China. This reveals, I think, a clear hierarchy of fears in today's market.
Yeah, it shows that acute, immediate threats like the sudden risk of a trade war or a credit contagion, they dominate short-term market sentiment. They dictate sudden, violent swings like we saw Monday. Chronic long-term risks like slowing global growth or structural inflation, those are much easier to overlook or maybe just push off until tomorrow. The question then becomes, how long can U.S. stock optimism, driven by domestic resilience and earnings potential, afford to ignore the cautious global signals coming from commodity markets like WTI crude?
The rally suggests confidence in the domestic picture.
But the falling oil price implies a significant global headwind. Keep an eye on that divergence because that chronic risk, well, it will eventually demand the market's attention.